The SEO trading system, simple, easy, and objective, has a big advantage over most other trading systems in that it guarantees you will never miss a big move. That's right, the SEO trading system guarantees you will never miss a big move. Another big advantage is that the risks are known prior to entering a trade. You can easily define the risk level that you would have to take in trading this particular stock or ETF. And when we covered the stock score tables, two of the column entries were ATR, average true range, and last price. And you can review that video if you need to. But by combining those two, you can pretty much determine if a stock or ETF is a good candidate for your risk profile. Now, this video just covers the entry basics of the SEO trading system. We don't filter the trades. We don't go into the wisdom of any particular trade. We just want to introduce some terms, define them, and disclose or provide you with the basic entry rules. So there are three elements that we have to know. One is the breakout bands. And the breakout bands are three moving averages, a long, a medium, and a short, and they're offset forward. For the daily bars, we use a 13-8-5 combination. For 130-minute bars, 21-13-8, and for 65-minute bars, 34-21-13. And let's look at what the breakout bands are. And the breakout bands appear in the campaign chart and in the 120 bar chart. But the blue is the long, the red is the medium, and the green is the short. So there's a couple concepts we want to cover here. When the stock price is above and clear of the breakout bands, the stock is in a bullish move. When the breakout bands are clear and below, or when the stock price is clear and below the breakout bands, the stock is in a bearish move. And when the stock price bars are intertwined within the breakout bands, we're in a consolidation mode. The next concept we want to cover is the Elliott Oscillator. And the Elliott Oscillator is a 534 MACD, and we show it only in histogram form. Now, we've colored the histogram bars blue and orange because color experts and psychological studies suggest that this high contrast color combination is the most neutral. In other words, if these were red and green, which are commonly used by some software, that automatically creates a subconscious bias. The blue and the orange don't. So you're not going to develop any subconscious biases just from looking at the colors. But the Elliott Oscillator is very easy to read. When the bar is blue, it means that that bar is higher, momentum is higher than the bar immediately preceding it. And when the color is orange, that means that momentum is lower. The numerical value of that bar is less than the bar immediately preceding it. So just by looking at the Elliott Oscillator, you can tell if momentum is increasing or decreasing. Now, the change in color is important because that's step one of the basic entry process, the alert. A change in momentum, in other words, the Elliott Oscillator changes color, is called an alert. It's not a signal, it's an alert. And we've just placed arrows on different alerts that occurred on this particular example of the Elliott Oscillator. And an alert is simply a change in color of the Elliott Oscillator, which means there has been a change in trend. Now, an alert is not an entry signal, and not every alert will result in an entry signal. But the alert is the first step. It's the first stage of the entry process. Now, the third element that we have to learn is the 3-bar high-low breakout price. And I've just put some arrows on here as examples of 3-bar high-low breakout prices or breakout bars. And what that means simply, say for a high breakout bar, is that the high price immediately preceding it and the high price of the bar immediately following it were lower. They could be lower for more than the immediately preceding and succeeding days, but that's the minimum requirement. And for a breakout bar low, then the bar immediately preceding it and the bar immediately following it had higher lows, and that's the minimum requirement. So we call a bar that either high or low, is not matched by immediately preceding and immediately succeeding bars, the breakout bar. So if we combine the three elements, then the three-step entry process is that we had an alert, we had a change in momentum, and as price progresses after the alert, price exceeds the 3-bar breakout price, whether high or low, and the entry bar is clear of the breakout bands. That's the three-step entry process that's unfiltered, and at this stage of the learning process, we're not discussing whether it's a good trade or a bad trade or a wise trade or an unwise trade, but we just have to understand the mechanics. And this is an example, one example, where at number 1, we had an alert. There was a change in momentum. And when the change in momentum occurs, we can go back and look at the first breakout bar prior to the alert. And we can see that it would be this high bar here, which we've indicated with the green arrow. That's the breakout bar, and the high of that bar would be the breakout price. Days progressed. This is a daily bar chart. And we then had a breakout above the breakout price. And as we can see here, with the arrow pointing to number 3, that the price at which the breakout occurred was clear of the breakout bands. That satisfies the long entry rules. So we had an alert. We went back to look at the first breakout bar before the alert. We then followed the price moves, and we had a breakout above the breakout price, clear of the breakout bands, triggering a long entry. Now we can look at other examples here also. And this is a campaign chart, and just to assist you in implementing the system, if you right click, you can put in the breakout prices so you don't have to go searching for them. They're tinted slightly red if they're bearish and slightly green if they're bullish. But we'll use this example here. We had a change in color on the Elliott Oscillator from orange to blue. That means there was a change in momentum. And that occurred on this bar. And we look at the immediately preceding breakout, and it was 169.50. And we can see that the change in trend occurred above the breakout price, clear of the breakout bands, resulting in a valid long entry signal. And we would then have followed that up. We'll cover stops and initial stops, continuation stops in later videos. Right now, again, we just want to make clear the concept of entry. Okay, so we'll go forward, and our next change in trend color occurred on this bar here. So now we have, this would be the immediately preceding, the 174.76 would be the breakout bar price. So once the change in trend occurred, we would look and see if we had a breakout of the price. And we can see that that occurred on this bar here, this long black bar. But it was not clear of the breakout bands. So we had the first two conditions were satisfied. The third condition was not, because the price was not clear of the breakout bands. So this would not be a valid short entry signal. Momentum changed again here. And we can see that this did result in a valid entry signal because we had a change in momentum. We had a breakout bar price exceeded, clear of the breakout bands. So this was a valid entry signal. And it would be a good idea just to go through and practice this for both long and short entries. But again, let's just review the three basic criteria. There's a change in momentum, i.e. a change in color in the Elliott Oscillator, and price exceeds the 3-bar breakout price, and the entry bar is clear of the breakout bands. And those are the basic entry rules, again, without filtering and without any further input into the wisdom of that particular trade.